For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Managing Your Financial Future. Welcome back to the program. Another episode gets underway. Johnny Dean, your podcast host, here with my good friend, longtime, co-host?
Sure, guest.
Sure, guest. You're not really a guest. You're
Advisor.
really the co-host. You're the advisor portion of this. Rick the Professor Plum, a CFP professional, certified financial planner, R with a little circle around it, registered trademark of the whatever corporation. Nice to have you back here. I got some, we talked at the end of the last program and maybe the previous one. We usually give you the email and say, why don't you email us and ask your questions? And we do get them. Sometimes you answer them off the air. It occurred to me that we don't get to these on the air. And some of these have referred to some of the topics we've talked about over the last month or so. And I wanted to just throw out some of these emails at you, Professor Plum.
Okay.
One in particular, because this is kind of a unique point of view, I guess. So I'm going to start with this, and then we'll discuss this having to do with 401ks and traditional IRAs. And then I may get to some others. We may just take care of some emails today.
That's fine with
because
me.
These are great questions, and I'm trying to find the ones that are not too detailed.
Into the weeds.
Yeah, exactly. And some of them do get into that. If you want to email us, by the way, go to luciacap.com, LUCIACAP.com. All right, so I wanted to get to this one. Mel in Surprise, Arizona. Mel says, I heard your discussion about the benefits of leaving money in a 401k versus transferring to an IRA. We had talked about the difference,
Pros and cons.
Mel says, I too left money in a 401k because it was invested in a stable value fund because I liked the yield and the guaranteed safety and liquidity. There are some issues with leaving money in a 401k.
True.
And we've talked about this before, Professor Plum, but he's bringing this up. Mel says, most plan documents specify that once you reach RMD age and have to take RMDs, then you must remove all money from the 401k.
I don't think that's the case anymore. A lot of them will just do the RMD every year. They don't make you force. Now, there are some plans out there that once you get to now age 73, they say, okay, either
they don't want to deal with it.
Take it all,
Yeah.
or,
Well, I think that may be what he's referring to.
Yeah. Some do that,
now,
yes. So you need to know what your plan allows.
Well, yeah. So Mel says, obviously, the best thing to do is a trustee-to-trustee rollover to an IRA in that case. Presuming for a moment, though, that one's 401k plan permits you to keep the money in the plan, then you must take a separate RMD from each 401k.
That was one of the cons, basically.
Yes, it was.
Now, the reality is the dollar amount of the required minimum distribution is the same. It's just that you have to take it from two separate or maybe multiple places. Whereas if everything's in IRAs, different IRAs in your name.
Well, this is what he says.
You can take it from one.
He says, well, you can aggregate money in all of your IRAs and take the RMD from one IRA. That's not the case with a 401k. It is unfathomable to me, says Mel, why this is the case, since you will still be reporting the RMD. The IRS will still get the tax due.
And the dollar amount's still the same number.
And he says you have to take the RMD from each 401k separately. Most people, and I don't know if I agree with this, many financial planners don't know this, according to Mel.
All the financial planners I know it, but
But we work with
smart people.
He says it can be a bookkeeping nightmare. Moreover, if a non-spouse beneficiary inherits the 401k, the plan documents generally prohibit the beneficiary from doing a stretch. The non-spouse.
Well, nobody gets to stretch anymore. Almost nobody.
401k.
Yeah, the 401k has the same RMD rules as an IRA.
Yeah, the non-spouse beneficiary must then do an IRA rollover with a company that'll permit. Anyway, they said that the bottom line was, he says, you're better off having all the money in an IRA. Now, okay.
And there are reasons to keep money with the 401k. There are reasons to, for the flexibility and the ease of management in some respects, roll it all to an IRA. It's just a matter of, I think that he must have an older plan and they just haven't updated it a lot. But there are some antiquated plans that are difficult to work with. Even one of the most popular ones out there, the thrift savings plan, which is technically not a 401k, but it looks and acts and feels just like a 401k that the federal government offers its employees.
Yeah.
it can be cumbersome to work with post-required minimum distribution age. There are reasons to keep the TSP. It's inexpensive as heck. It has only a few choices, so you don't get bogged down in paralysis by analysis of all the 500 different choices. You only have so many choices. But once you get to retirement, leaving the money in there and taking a distribution from the TSP, you can't say, I want to take it only from the safe fund.
Yeah.
Whatever you have invested in there and the
It's
different
across
options,
the board, right?
you're taking a pro rata distribution from every single source. So if the market's down and you're taking a distribution, you're taking it from a down investment.
Your reverse dollar cost average.
Which is not that healthy for your portfolio. They've made it more flexible in the last couple of years, but it still has some issues. And so some people really like it. And like I said, it has its advantages, but there are detriments and downfalls to it as well. So you have to look at them all and weigh them and say, okay, which one makes the most sense for moi?
Yes. Well, that's kind of where I was going with Mel.
Okay.
Because in Mel's case, it sounds like he says most plan documents don't allow you to do that. I mean, I don't know how many 401ks Mel has come across.
I've come across a few, and more are being more flexible, but they were that way for a long time.
Well, you're an advisor, and you see that.
I see this more often, yes.
I don't know how many 401ks Mel has, but he was suggesting that you're better off having it in an IRA.
Now, the good news is he has that stable value fund, and that was one of the reasons he wanted to stay with his 401k, which has been a great reason. But typically, now this isn't 100% across the board. This is just a typical issue with a stable value fund. The reason they've done so well for the last month, umpteen number of years, is the rate of interest that they pay typically lags the interest rates in the outside environment. So as interest rates were coming down for all those many decades, the stable value funds stayed just a little bit higher and came down later, so that the yield curve came down. But now that interest rates have come back up in the last year or so, the stable value funds are again lagging the movement of the interest rates in the environment. So at this point, they may be lagging what you could do with treasuries and other safe investments.
They'll catch up eventually, historically.
And if interest rates start to come back down again, however you want to look at it, the stable value fund will lag that downward trend then. So it's
like the front of the roller coaster versus the back of the roller coaster.
Yeah, exactly.
Right?
Yeah,
the front's on its way down, the back is still on its
going
way up. Yeah.
And then when it comes to the bottom, the front starts coming up before the back hits the bottom and then lags in on the way up.
Well, our point when we were discussing this, that the one that Mel was talking about, this was 3 or 4 episodes ago, I forget, is that you can't really make the blanket statement that Mel made, which was it's all better in an IRA. It's going to depend on your individual situation.
Right. Yeah. I'm probably biased, but I think the flexibility of the IRA makes a lot of sense, but that's, I think that's not a recommendation.
Well, no, but I've known people who have, kept their money in the 401k, right? And but they, this came up just recently. I found out somebody who had no safe, if you want to call it that, option in the 401k. There was no CD or money market or anything like that. So trying to find a bucket one to take out of the 401k was difficult until they were told, oh, by the way, you could, roll this to an I. Really?
Yeah.
So anyway, this just seemed Mel's email was interesting, and I hadn't heard that take before. I wanted to get your reaction to that. Want to do a couple more?
Sure, give me a shot.
Why not? This is kind of fun. Let's see. How about a Social Security question?
I've heard of that.
All right, why not? John in Clearwater, Florida.
A retiree in Florida, go figure.
I know. How about that? Wow, who knew? Let's see. I'm 58 and a widower. Really? I've paid into Social Security throughout my career, but my late wife was a California school teacher and did not pay into Social Security. I will receive a widower's benefit from CalSTRS. Now, that's the
California State Teacher Retirement System.
Right. He's going to get a widower's benefit from them starting at about a year. Will that benefit subject my Social Security benefit to an offset? He says, WEP, GPO, GTO, I don't know what it's called.
Well, the WEP and the GPO, the Windfall Elimination Provision and the Government Pension Offset, are things that will affect your own Social Security if you have a pension that was not covered, from employment that was not paying into Social Security. So my question to him would be, do you have a pension that you earned in a position where you did not pay FICA taxes?
My guess is no.
You do not, even though Cal Sturz is a pension that his wife earned in an employment where she did not pay into Social Security at the same time. He doesn't have that same issue. So the WEP and the GPO, even though he's receiving a widow's pension, a survivor's pension from that state, it will not affect his Social Security for a couple of reasons. One, primarily, because it's not his pension. He's the beneficiary of the pension.
Yeah, so he can receive the pension amount and get his full Social Security benefit.
Yep.
We don't talk a lot about this
That's
pension
the opposite
offset
side of it. The other way, if he had been the one that passed away and he had his Social Security benefit and his wife was eligible for a Social Security benefit from his passing, but she had the Cal Sturz, that would affect her ability to get some of his or any of his Social Security. But going the other way, it doesn't affect it in any way, shape, or form.
And I can see how that gets confusing. I don't know that a lot of people know that their pension, if they have one, where they did not pay into social from a job where they did not pay FICA, we'll say it's not FICA.
Right. Well, it is FICA. That's what you're looking for.
That's what I'm saying, where they did not pay FICA.
Right.
Not FICA Medicare, because they pay the Medicare.
They do mostly pay Medicare.
But where they didn't pay FICA, that pension could have an effect on your own Social Security benefit.
It can have an effect. If I have a pension from work that I earned while I was not paying into Social Security, it will, and I've also worked enough, 40 quarters, to get my Social Security benefit. It will have an impact on my Social Security benefit, and it will have an impact on any spousal or survivor benefit that I might be eligible for from somebody else's Social Security work record. And I should phrase that, it might have an impact on my own Social Security benefit, because there are ways to reduce the impact by working and paying into FICA for a long period of time. Maybe I was only a teacher for 10 years, but I worked
30 years
outside, and paying into FICA at a reasonable rate for 30 years. Then I won't have an issue with it.
No, it's
still will have an issue with the GPO, but not the WEP.
Yes. And
my little GPO.
maybe we'll do a whole separate thing on that.
But that's important to know when you're doing your planning, though, because you have to understand when you're looking at survivor options and things of that nature, what is going to be available for that survivor in the event you pass away, or vice versa, your spouse passes away, it's going to be available for you.
Yeah.
And do you have enough? Should you be looking into some other form, maybe getting a life insurance policy to support that if that individual passes away too soon?
Yeah. Planning well ahead. Now, poor John, 58 and a widower. Wow, it seems awfully young. Wow. All right, let's move along. Let's see.
But he got the heck out of California.
He got out of California to a non-tax state. Let's see. Kevin in Houston, Texas. I'm 25 years old. I get no 401k match from my employer. I'm curious about doing both a traditional and a Roth IRA. Or should I just do a 401k? Is it a good idea to spread the tax liability around and secure some withdrawal flexibility for the future? What would be the major downside? Now, Kevin is looking ahead, and he's
starting to save.
We have talked about this when we talked about having different
tax buckets,
things
of
income. Right. You can take
sources.
a taxable, a personal, or maybe a Roth.
Right. So I have, the blanket answer would be just, start with the Roth, because there's no match on the 401k. Right. Now, the question I would have, though, is how much money are you making? Have you bought your first home? When might you buy your first home?
Yeah,
I would say starting with at least some money going into a Roth IRA at 25 gives you some flexibility. Get the 5-year clock started so that you 5, 6, 7 years from now can use some of that money for the down payment on a first-time home purchase.
Some of the earnings.
Well, all of my contributions and up to 10,000 of the earnings of the Roth I can use for a down purchase on a house, up to not maximum of 10,000 of earnings, but let's say I'm putting 5,000 a year into my Roth IRA for 6 years. I want to get past the 5-year mark. I've put 30,000 in, and it's worth 40,000. Purely making numbers up here. I could use that entire $40,000 for a first-time home purchase out of a Roth. The 30 that I've contributed over those 6 years, 5,000 a year, comes out to me for any reason, that's just my contributions coming back. I don't have to claim any exemptions. That's what it is. The other 10 that was attributable to the earnings, that's my first-time homebuyer exclusion, which comes out of a Roth tax-free, penalty-free. So that's not a bad way to help save for a first-time home purchase. Now, he may already own a house, so that's not an issue. What is going to give him the best use? If he's making, $150,000, then that tax deduction may make some sense to him, at least feeling good right now. Mm-hmm. But most likely, depending upon how much he wants to save, maybe a combination of the two. If he says I can save, if he's making $40,000, $30,000, and he's making, he can only make $2,000 or $3,000 of contributions, I kind of like the Roth. If he's making $150,000, you have a much higher savings limit, obviously, in the 401k. Then it's a question is, does your 401k offer a Roth option?
Hey, we talked about that recently too.
And let's see, what are the benefits? What is it? Where are you on the income scale? Mm-hmm. Where are you on the savings scale? And what works out best for you?
Kevin, if you want to email us all that missing information,
but
feel free.
The reality is, any one of those is going to be better than not doing anything.
Yeah.
Whether he does a Roth IRA, traditional IRA, the 401k, Roth 401k, just do something. That's better than not doing anything.
Oh, it always is. Even if you stick it in your safe.
Yeah.
Right.
25, my guess is he's probably going to want to go Roth. And if he's got a Roth option at the 401k, use that too. And you can get quite 22.5 plus 6,500.
The Roth 401k.
The Roth 401k and then the Roth IRA.
Find an employer also that matches too. By
the way, get a job with a matching contribution,
right? And start making some decent. I mean, I should.
We don't know what he makes.
I know that, but if he starts making some really good money, 25, you're probably not making
25.
Top
The
dollar.
hardest part about investing isn't should I buy XYZ or ABC growth mutual fund. It's having the money to put into one of those funds,
right? And just let it rip.
Discipline of saving.
Let it rip, right?
Get the discipline of saving started,
and then put the pedal to the metal and
the thing to the floor.
Thing to the floor. And, you and I with our movie references. All right, well, there's that. Good stuff. Let's see. Do you have your calculator? Well, maybe you know.
I have a calculator anyway.
Oh, okay. All right. I know you're never usually far. Maybe you don't need it. This is from Levi in San Antonio, Texas, who just wants to know, how much will I owe in taxes if I withdraw $19,000 from my 401k and I make $40,000 for the year? I'm 33 years old, if that matters.
Single?
33. Let's say married. I don't know. He didn't say.
Well, if he makes 40, this is the problem. What does his spouse make?
All right. Let's say it's $40,000. Let's say single $40,000 household income.
Single $40,000 household income. So basically, call it about 10, not 10% of the whole thing. So you take 40 minus 30. So you're taking 19 on top. So the 19 is all going to be in the 12% bracket. So 12% of $19,000.
Okay, so it's what, 1,900 plus a couple more percent. So a little over $2,000, something like that.
2280.
2280. All right. These are not terribly exact numbers, Levi. We're just going by what you told us.
But you figure you're in the 12% bracket at that level. And it's all in the 12% bracket, because that's the way the brackets work.
Eileen in Tacoma, Washington. Let's just keep running down these. Eileen, here's something we haven't talked about for a while.
Where was the last caller from? I'm sorry, I missed that.
The emailer?
Last emailer.
That was San Antonio, Texas.
Okay, so far we've had 3 states represented, all tax-free.
Well, we got a fourth one because Eileen is in Tacoma, Washington.
Well, that's what I mean. We've had 3 states.
Oh, 3 states.
Florida, Texas, and then
4 emailers. Wow.
4 emailers, all
tax-free
states.
Surprise Arizona.
Surprise, okay.
Yeah,
but surprise, I missed that one.
All right. Eileen, Dad passed 3 years ago. Mom decided the house was too much to keep up with, so she bought a garden-style house and paid cash about 5 miles from where she lived.
Okay.
She stayed in her home while the new one was updated and moved into the new house in April of this year.
Okay.
Her old house will close escrow next week.
Good. She's selling it. No, she sold the old house.
She and Dad lived there for 40 plus years. Sale price is $630,000. I think they paid around $60,000 for it back in 1970, whatever it was.
Well, here's the good news. Well, that date doesn't matter.
Well, okay, yeah. So she said, you talked yesterday about a $500,000 exemption from taxes for married people, but because she's single, will she owe taxes on the sale? So give her the news on this.
Well, speaking of the $500,000, a surviving spouse still has access to the $500,000 for 2 years after the death. Now it's been 3, so that's not going to be available here. But don't worry, don't despair. The date that they bought it way back in the dark ages doesn't matter anymore. They received a new basis. It's as if they paid for it the day he passed 3 years ago. So the only gain that's going to be recognized on the sale of this property is any gain that happened since the date of his death. So let's say it was worth $500,000 3 years ago, and now they're selling it for $650, was it? $625? $630. So under that example, there's $130,000 of gain. And your mom can use $250,000 of her own exclusion to offset that $130,000 again. We don't have to go back to the date of purchase.
It's the date of death.
It's the date
there was
of
a
death.
Step up in basis.
I'm assuming they owned it as community, it's community property in Washington.
Yeah.
It's available in Washington. If they lived across the river in Oregon, it's not available. Then we have to look at who owns what. But
right. Okay.
But they received a new basis on the date of his passing, and so she doesn't get the $500,000 because it's been more than 2 years, but she still gets the $250,000. And we don't have, unless that thing grew by $250,000 in the last, 2 years, 3 years.
Yeah.
We had quite a bit of appreciation. I don't know if we had that much. That would have been nice. Taking it from what, $370 to $630, or
yeah,
$380 to $630. That would be a big jump. So you're probably not going to have to worry about any taxes. You just have to. And somebody will say, "Well, I don't know what it was worth 3 years ago." Well, there are appraisers that specialize in doing forensic appraisals and go back and say comps at the time, doing all this.
Mm-hmm.
Spend the $500 and get the appraisal from 3 years
That's
ago.
That's probably an important thing to do,
and have it, in your tax records, so that if they ever come back, and then when you file the tax return, if you get a 1099 for it, you just tell your tax preparer, here's what the basis was,
mm-hmm.
and they'll take care of it, and you won't owe any, unless the gain is more than $250,000 since he passed. It's not going to be an issue.
The $500,000 exclusion for married people, which has now been around for
what that is $250 per person.
Per person, right? So you have $250 for one spouse, $250 for the other spouse. Now you said, either I didn't know or I forgot, that you have 2 years from the date of death to take the if you were married.
Use the $500.
You could use the $500 for 2 years.
Yes.
That's from the date of death.
Yes.
Okay.
I'd have to look at that. I think it's 2 tax years.
Okay.
So it depends on when they died during the year. Because if they
let's say somebody dies in March.
Well, then of what year? 2021?
Let's say it was March of this year.
This is where I'd have to go back and read the fine print. I don't have this one exactly memorized. I'm sorry.
No, that's okay. But there's a 2 year.
There's a 2 year thing.
So they wouldn't have to sell. Let's say they died in March or April of this year.
Well,
they wouldn't have to sell. They wouldn't have to say, "Oh, gee, I only got till December to."
Right, but this affects people in separate property states, which
right,
are the majority of the states,
where they don't get a step up.
The house the house is in the name of one spouse, and it's not in the name of the spouse that died. It's in the name of the spouse that lived, that survived, and so there's no step up in basis on that in that respect because the owner of the house didn't die, and so then you're looking for I still have my original basis of $60,000 that I paid for it back in 1978. Mm-hmm. And I've got, all this gain. How do I try to offset some of this gain? And so that's where they gave them some time to be able to sell that property and still maintain both exemptions for both owners.
Which is good.
That's nice.
If somebody dies in November, you don't want to say, well, you better make a decision here in the next month. You better sell it in the next month.
But they could have said that you had to be alive at the time of sale.
Yeah, they could have said that.
But there's a two-year window. Sometimes
they're nice. Other times they're just evil.
Well, it's probably more that it suited one of them when they wrote the law. It's self-serving.
Well, it always does.
Self-serving.
What was the last really good thing? The Roth, okay, for everybody. I have to go back to the Roth IRA as being the last really good tax thing that
happened basically the same time as this $250,000, $500,000 personal home exemption happened.
Right. It was right within a year.
Yeah, within a year
of each other, 1997 and 1998.
Now the difference between those is since then they've added more Roth options, and they've actually pushed the idea of doing Roth 401k and IRAs more, where they've taken the original rules for the 250, 500,000 exclusion, and chipped away at the outside edges of it, where you can't use the rental properties as easily as you used to and do things of that nature.
But they have given, very, very wealthy people the ability to pass even more money every single year down to their heirs, right?
Well, so far.
That's what happens. When you give Congress to billionaires and millionaires, this is what you get. I don't want to get into that. Anyway, so there you go, Eileen. That's not bad. Do we have time? I got time for one more quick one here. Are you doing some math?
Well, I couldn't remember what the exact estate exemption was.
For this year?
Yes. What,
it's 20, 13.
Yeah, it's just shy of 13.
Oh, it's
$12,920,000 is the estate exemption per person.
Oh, see, that was like 13. What? This is for 2023?
This says 2023.
Okay, well, you're going to be right. I guess I've rounded it up to 13 million for the last couple years, so I just assumed it was higher than that. So okay, let's do one last one.
If only we had to worry about it, John.
I'm hoping someday. I don't play the lottery, so that's not going to happen. I don't gamble, so that's not going to happen.
I want my kids to have to worry about an estate tax problem when my wife and I pass.
I do too. In fact, I would be so concerned that they're going to have an estate tax problem that I may just wind up spending it down.
Yeah,
I don't want you to have this problem.
I'm going to spend this money before I go just so you don't have to worry about estate taxes.
Exactly.
I'm going to bring this estate under $25,840,000 just so you don't have to worry about estate taxes.
And you're welcome. So long. We're off on first class round trip around the world.
At that point, no, it's my own jet.
Okay, my own jet. If I want to spend it, that's true. Corey in Las Vegas, this should be a quick question here. Hi, he says.
Hi.
If I do a lot of jobs like Uber, Instacart, and all that, should I have an LLC or an S corporation? Is it better to do one? I don't know what he's saying. I think he's saying, is it better to do one like this for these tax purposes?
Well, for tax purposes, the LLC is not going to do anything for you.
Nope.
The LLC really doesn't do anything. The S Corp is not going to do a whole lot either, because it's going to be very hard to differentiate between your work and the company, the S Corp, profit. You are the only person in the company. Every dime of revenue comes from what your physical labor is.
So there's no dividend.
There's very little opportunity for dividends but I mean, it can work. I mean, but it also depends on what state you live in. But
he's in Nevada, so, okay, so that's a plus.
Yeah, the S Corp franchise tax isn't all that bad.
But you can own a true Nevada corporation.
The big issue is not going to come from the income tax savings, because and a business exemption expense is a business expense. But where it comes in, let's say you make $50,000 net of all business expenses. If you're an S Corp, it's still going to show up on your sole proprietor, and you're going to pay self-employment tax on $50,000. If you're an S Corp, you can say, well, I'm going to take a salary. Maybe I take a salary of $36,000, and the other $14,000 is payable as profit. I'm purely making these numbers up. Don't hold me to these. I don't know what's justifiable and what's not, but of the 50,000, 36 was profit. The other 36 was salary. The other 14 was profit. Well, that 14,000 of profit that comes to you is not subject to self-employment tax.
As in FICA Medicare.
FICA Medicare is what an employee pays. And the employer pays an amount equal to that on top of the person's salary. Mm-hmm. So with 15.3 instead of 7.65 and 7.65, which equals 15.3. So if you're only paying yourself $36,000 in salary, you and your employer, are only paying 7.65 and 7.65% on the 36, not the whole 50. So you're basically saving that 15% on that $16,000 of hypothetical profit that I just talked about. That's where the tax savings for the S Corp for this type of an individual is coming in. I'm guessing that doing Uber and all these kind of things, I don't know what a really hard driving person can make on that, but the wage base at $162,000, I'm not sure that they're going to be making profits or total revenues after expenses of $162,000.
You mean from Uber and
from
Instacart and
from all those deliveries?
That
would be really driving a lot.
Yeah,
but so typically you're going to be able to do it by, if you do the S Corp and you can somehow justify that you have profit that's not necessarily from you. I mean, if you want to get really crazy, your car could be owned by an LLC, and you're the driver of you, and so your S corp employs you, but it rents the car, and so your S corp pays an expense over to the LLC, which then flows through you as a pass through, and you take the profits. You pay yourself a salary out of your S corp that's equal to everything you make there, but you split it that way. But now you're paying for two different entities.
And try to keep tabs on the tax. I mean, my goodness.
Well, you didn't ask about that part.
I didn't. Well, I had an S corp for years, and I had to pay. It was not worth it to me in the end. The amount of money that I had to pay myself a salary.
I had payroll.
I had to hire a payroll company to pay me.
Well, they had to keep track of your quarterly payments, your FICA
they
payments,
made it,
and all
right.
that.
And that there was a cost to that. And then in California, where I am,
$800.
$800. It's never changed. Is it still $800?
As far as I know, it is. I haven't checked lately.
Well, it was $800 20 some odd years ago. And
don't give California any ideas.
Oh yeah, they're going to listen and say
they're going to increase
like they've never considered that before. Hey, but I want to.
They don't tax Social Security yet.
That's what I want to keep quiet. That's what I want to keep quiet. Quiet. Yes. No, we're not going to say anything about that. They're waiting until we start our Social Security.
Yeah,
and then
that's the way it works for me.
Is the way it is. We're out of time. This has been good. And I had a few others here. Maybe we'll do this next time. I don't. We've had a few 401k topics over the last couple of months, and we've gotten some questions on those. So I think maybe
go back into
next
401k
time
topics?
Or in another one next time or after that. We may continue to do this. I like these different types of questions that we get, and I think it shows your versatility as a person who's not just talking either about buckets or whatever it is. I mean, you can
do that too.
And I purposely did not give you these questions ahead of time.
Right. This first, you notice by how much I interrupted you.
I understand
on some of these
that. Yes, because
I had not seen them beforehand.
Yes, you were already giving the answer as they were
going to give me later.
Exactly. So, anyway, thank you, Professor Plum. This was fun, and we'll do this again. In the meantime, you want to get in touch with Professor Plum or any Lucia Capital Group advisor, 800-644-1150, 800-644-1150, or go to luciacap.com, LUCIACAP.com. And you can get lots of this same information in video form and downloadable PDFs, all that stuff. You can get your questions answered there, and you can send us a question there at luciacap.com as well. For Professor Rick Plum, a CFP professional, I am your podcast host, Johnny Dean. Thanks again for listening. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Stable value funds can be viewed as an alternative to money market funds. However, there are important differences, and stable value products can be complicated. Unlike money market funds, stable value funds are typically not registered with the SEC. In addition, they are not guaranteed by the U.S. government. The structure of or investments within stable value may vary, and it is important to consider these differences in selecting a stable value fund. Money market mutual funds, though traditionally lacking federal insurance and not without risk, are highly regulated under federal law. Before investing, carefully consider a stable value or money market fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.